Okay, now we'll get to the important stuff. There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 50s. In the decade of the 50s, there's this big theory that the Depression was caused by a stock market crash. Totally wrong. Less than 1% of Americans owned stocks in '29. We had this big time recession. In fact, it was a depression. That's what, it wasn't caused by the stock market. The economy went down, the Federal Reserve raised interest rates, and we had a big time depression. In fact, we had several depressions like that from 1850 on. This was only one of about 8 depressions since 1850. But people thought the only reason we got out of the depression was World War II, and they said once we get back, next time we have a recession, we're going to have a depression. And it's going to be a great depression. I never understood that adjective in front of depression. Now, you ought to be crummy depression or bad depression, but it was always great depression. I never quite understood that one. So people weren't buying stocks in the 50s because they thought that another Great Depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking with canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy Eastman Kodak. I mean, the syllogism just doesn't work out, that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, you know. And I remember in the 50s, I mean, I remember literally in classes, I was in elementary school in the 50s, and they'd come in, they'd have one of these air raid drills. Somebody with a yellow hat would come in, they'd blow a whistle, and you'd get under your desk. Even then I says, I don't think this is going to do a lot of good, you know. But people were worried about a depression and nuclear war in the 50s. And then, I mean, the warheads, they couldn't do much damage back in the 50s. Now one of these Stan countries, you know, these Kakistan and Kazakhstan, all these Stan guys that have spun off these Friedman Billings spin-offs from the Soviet Union, they didn't lead it. There was a co-deal with somebody else, like Goldman Sachs, and they were on the left side, though. Every one of these little countries has enough warheads to blow the world up 88 times. I mean, who's built a fallout shelter there, you know? We stopped worrying about it. I mean, there's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade this century for the stock market, except for the 80s. Only slightly better. The 80s were only slightly better. People didn't expect a lot. We had an okay, it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. Do you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks are going to go bankrupt, and we're going to have a Great Depression, and the stock market's going to go down, and you're going to wind up selling pencils and apples. You know, well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4, and we're going to have a depression. And people believed it again. You know, I remember when the money supply was growing too fast, and they said we're going to have a depression. Then it was growing too slow. We're going to have a depression. Remember the LDC debt? Remember the LDC debt? All the banks. Our banks are very smart. They lend all their net worth to Zimbabwe and Botswana and Botswana and all these countries. Chile, a lot of countries they can't pronounce. This is Chase Manhattan and Chemical that manufactures Hanover. These countries weren't doing so well. Then they were called undeveloped countries or less developed countries. Now you have to call them emerging countries. It's not politically correct to call anybody an undeveloped country. It's like I just found out the other day the term for somebody that's overweight is laterally challenged. You have to say something laterally challenged. But these were LDC debt. They were all going to go bankrupt, and we're going to have a depression. Then the Mideast was going in the world. Remember that one? The Mideast was going in the world. They weren't going to buy our bonds, and the market crashed, and we're going to have a depression. Then Japan was going in the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system's in trouble. And people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list, at the end of the day, they had eliminate crippled children and Mother Teresa. They're praying for Japan. I mean, you know, it's a country with a 15% savings rate. You know, it's something bizarre. You know, commercial real estate, global warming. You know, and I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors, is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. You know, Get a 7-year-old and ask him if he knows about the money supply, you know, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. You know, ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. In fact, from 1955 to 1985, the stock market went up a grand total of 1,000 points, but it was down 800 on Mondays. So it was therefore up 1,800 on non-Mondays. It wasn't an accident. The stock market went down. October the 19th, 87 was a Monday. People over the weekend become economists and portfolio strategists. You know. I mean, they're a bull if they take their lunch on the way to work. You know, in fact, I knew very well the market was going to go down in October of 87. Dave Elson remembers that. It was my first vacation I was going to take in 6 years. And we decided to go to Ireland, and we stayed at all these little cottages and play golf. And I left on Thursday after the close of trade. The market was down 55 points, which wasn't a good start, but it was down 55 points. And we got over there, and because of the time zone, we were able to do what we wanted to do and get down to Cork, and called in the market was down about 118. I said to Carolyn, if the market goes down on Monday, we better go back. But we're already here, so I'll also stay for the weekend. So as you know, the market went down 508 on Monday, so I flew home. Because my fund had gone, I think, from 13 billion to 9 billion in 2 working days, and it was, the trend here is not positive, like I could do something about it, but there's something when they called, they wanted to say, well, what's Lynch doing right now? Well, he's on the 10th hole, he's even part of the front 9, but he's in a trap right now. This could be a double bogey, this could be a quadruple bogey right here, could blow the entire front 9 right here, this is not what they wanted to hear, so I have no idea when the market's going to go down, and no idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A little while ago, it's 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody. Or they're not in this room. They're down in Palm Springs somewhere. They've made $1 billion. Or if they know anything about interest rates. Because in interest rates, if you can be right 5 times in a row in 10 grand, you can have 2 billion. There's not that many people with 2 billion. There's a lot of people predicting interest rates. Did you ever think about that one? Just 5 times right in a row in 10 grand, 2 billion. If you write 7 times in a row, you can have the GNP of, the United Kingdom. It's a big number. So I don't worry about that. I know we've had 96 years of century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% or more. So 15 in 96 years, about once every 6 years, the market falls 25% or more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with. I'll be glad to answer your questions. It's been great. Enjoyed it. And I want to start the questions. If they don't get the question, I'll read the calendar of offerings for Friedman Billings for the next month. Okay. Do you like international stocks? The question is, I found I was better overseas than I was domestically because there's just less coverage. There's less people following these companies. So I think my big theory, and I think it's valid, if you look at 10 companies, you'll find 1 that's mispriced. You look at 20, you'll find 2. You look at 100, you'll find 10. The person that turns over the most rocks wins the game. Overseas, the numbers are much better. There's just not that much coverage. So I think international stocks are definitely worth looking at. When do you sell stocks? When you sell a stock is exactly the reason you buy it. You write down the reason you bought it. I bought Subaru. Subaru was a distributor. They didn't actually make the cars. I think it was Fuji Heavy Industries made the cars. They distributed Subarus in the United States. The stock was, I think the stock was 80. It was up from 6 to 80. I was a little late on this, but it didn't bother me, and I should never let that bother you. I didn't let it bother me. They had $40 a share in cash. They had a very low-priced car. It was well-liked. And it did well for about 5 or 6 years, and I think the stock went from 80 to 320. But the reason I sold Subaru, thank you. The reason I sold Subaru is Hyundai came in with a low-cost car. Chrysler cut the price of Omni Horizon. Ford came out with a low-priced car at the end. All of a sudden, the Subaru was no longer unique. So if the car's not a buy, the stock's not a buy. That's what you're looking for. The reason you buy a stock, you keep it posted. If the reason changes, you go on to something else.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Excuse me. There's a lot of times people buy on the basis, the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now, unfortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. I was able to, this was compressed. And at 3, I figured out, you know, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? You know, what do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund, I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double nits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 that fool at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know,
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, I mean, you know, it's funny in a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes, and so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my 2 greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly, and they're doing awful, you wait till things are getting better, and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because their earnings have been terrible.
Well, your modesty actually makes an important point, which is people with the best batting averages in the world don't bat 1,000. I sometimes get angry mail, particularly during bear markets, saying so-and-so recommended such and such and it went down. Well, how often did you come up with a clinker?
Well, this is a funny business. You don't have to be right even 5 times out of 10. If the times you're right, you make a double and triple. It offsets all those times you lose 20 or 30%. So when you buy a stock, you ought to say to yourself, how much can I lose and how much can I make? And you ought to be able to make a lot. Because stocks are risky. I mean, look at how much we lost in AT&T. Look how much we lost in Xerox. These were quality companies. You know, you could lose a lot in a stock. So you got to say to yourself, how much can I make? Because I want to buy a stock, if I'm right, I'm going to make a double or triple.
Does your own confidence ever get shaken?
Every day I think the market's going to go up. You know, I keep calling a lot my company, so I keep calling the company.
October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was, not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from I think 12 billion to 8 billion, and that gets your attention, in two working days. I said at the end of this week I'd be have no fund. Now there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open. By 12 o'clock it was in Ireland. It was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, if they called up and they said, well, what's Lynch doing? They say, well, he's on the 6th hole, and he's, he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. As though I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. As long as the times you're right, the company's doing well, they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it. That's all I ever know about the stock.
Day on Wall Street and other matters of investing, and I am very pleased to have him back at this table. Welcome back.
Hey, Charlie, good to see you.
It's smart of me to schedule you on a day like this. 3 months ago, I said, when do you want Lynch to come in? Right. I said, let's get him on Tuesday. Something's going to happen in the market that week, and so here we are.
Glad to be here.
Explain to me what's going on.
Well, we had a huge run. I mean, the market was 4,000 just, 2.5 years ago.
Yeah.
And it ran up to 8,300 in August. And, like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow.
And it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000. And that caused 7 years of inflated real estate, people overspending. And basically, they've been in a recession for 5 or 6 years because the market went up too high. I mean, if the market goes up too high, I mean, if the market goes too high, you're discounting earnings 7, 8, 10 years out. There's a relationship.
So everything is overpriced.
Yeah, and that doesn't help anything. The market since World War II has sold between 10 times earnings and 20 times earnings. If you look at the Dow Jones or the S&P 500, if you add up all the companies and take the earnings, you say there's a relationship. And it follows. McDonald's earnings have been terrific the last 30 years, and the stock's been terrific. There's a direct relationship. So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range. There wasn't a lot of room left on the PE
of 20
side.
is at the top of how high it should ever be.
Right. It's been over there only a few times ever over 20. And that's when usually inflation's about 0. In the early 60s, when inflation was about 0, we got a little bit over 20. Now we have a very low inflation rate. So if you usually have subtracted inflation from 20, you've had the PE of the market. That's been a pretty good ratio. When inflation was 12%, you remember in the early 80s, we had an 8 or 9 PE of the market.
So Dr. Lynch says all of this has been good for us?
Well, I'm telling you, it would not have been helpful.
It's like a purgative or something.
I never thought I'd ever wish for the market to not go up dramatically. But let's argue the market went to 16,000 tomorrow.
Yeah.
Basically, there's earnings behind companies.
Okay, but I'm not arguing that. I know that's true. And
That would be crazy.
And stock market price ought to be dictated by earnings and earnings performance and future earnings potential,
That's
right?
That's right.
I got that. Even I got that.
Right.
Now, let's just take this for me.
Sure.
Was the decline yesterday, in a sense, it let off some of this overvaluation? The market was even overvalued at where it was, and by letting it off, then we got back to what was reasonable.
Well, yeah, I would say fairly priced. Maybe for the larger companies, they're now okay. There might be some small companies. I mean, we've had 3,000 companies come public the last 4 years. That's 2 a business day. Yeah. Some of those companies have gone down dramatically, and that's sort of a research zone that average people in the stock shop, that's where you can find. Some people know a lot about this. 10,000 public companies. A lot of them are very attractive. No one's following them. I mean, there's lots of people following IBM.
Well, that's
lots
how you
of people
got rich following companies that nobody else followed.
Right. I'd like to go to see companies with unions or companies in trouble or companies that no one looks at.
Hotels that had nice beds.
Well, yeah, and you have to look at a lot of them. You
or
look at
pantyhose your wife wore. I remember this story.
Oh, okay, you got Pier 1 Imports. My wife found that one too.
Yeah.
But you have to look at 20 to find one. It's just you don't go to the mall and find the stock. I mean, you have to say, my God, this sounds like it's good. And then you have to do some steps. You have to do an organized method. People are careful when they buy a toaster. They're careful when they buy a seat. They do. They do some research.
But they don't do it with stock. They call up the broker, or they see somebody at lunch and they say, man, I got this hot stock, and you run right out and you spend $5,000, small investors.
Yeah. Or even worse, they put an option in International Data WAC. They don't even own International Data WAC. So they have a 90-day play.
But Bill said it was good and they make a lot of money.
Right. And it's like a casino.
Yeah.
So it's like a casino. You get the same results except there's more paperwork.
All right. But just stay with me in terms of people who are bedazzled by what's happened.
Right.
If you look at yesterday and you look at today, nothing has happened in the fundamentals of economics of any company.
Right.
But their stock may have gone down 10% yesterday and up 5% today.
One modest point, though. I mean, every time you have to get a memory. It's like it gets very cold in the winter in some parts of the country. You get a memory that winter's coming. Something did really happen in Southeast Asia. I mean, those
it did.
Those
was
economies.
That the cause of what happened in this market?
Well, I think so. That was a reminder saying, by the way, profits can go down. I mean, there is a downside.
But why was that the cause? I mean, did what's happening in Southeast Asia affect the earnings potential of all these companies you're talking about?
It did.
Because they can't sell their products there?
In a small way. No, because those economies have been growing double-digit, and all of a sudden now, they're going to, because of bank problems, because they're overfinanced, they're under-leveraged. I mean, they're going to have to draw on their belts. And then people said, whoa, maybe it'll happen. China's now the 4th largest economy in the world. Maybe China can go in recession. So this sort of woke people up. It was like a wake-up call saying, whoa, maybe there's a chance earnings are going to go down. I mean, this is not a big deal for the United States. When Mexico went down, much more important. But it sort of said people.
Why was it much more important?
Well, Mexico's
much more important to Mexico, much more important to us.
Much more important to the United States than Thailand is, or the Philippines. I mean, their economy is very important to us. They're a big consumer, very important. They're our neighbor, a lot of people there. That's a very important. When that went down, that affected Latin America was more important. So the recession of 1990, but it sort of reminded people. They'd say, wait a second, there is a downside. We've had 9 recessions since World War II. We'll have other ones.
Tell me what took place overnight between yesterday at the close of market and today at the beginning of market. What were the guys that you used to work with saying to each other at Fidelity, and what were the people you know saying? For example, IBM made a decision to buy back their stock, and that presented some kind of push on the market, and their stock went up 6 points.
Well, one thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60, and all they did was go to 50 and say, big deal.
So you're trying to find companies you liked anyway. Right now you liked them, and now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise, and then had a very, a 5-for-4 sale.
If you had been managing the Magellan Fund this morning,
Yes.
you would have been buying like crazy?
I would have been researching like crazy. I would have been saying, which companies are the same story? Is there anything really happening? This is a non-event for them. They're still doing well. Even if we have a recession, there's nothing to do with them. And that's the kinds I would try to buy. But let's say if a company, just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say, it has to work. And then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own
Okay,
it.
so this morning you get up and you go in and you look at those companies that fit
that you know something about. You have to have an edge. I mean, let's say the cement industry goes from crummy to semi-crummy to fairly good.
Yeah.
The stocks are going north.
Right.
You're going to make money. That's the industry you know. What if you know the publishing industry? Some people you have an edge. You work. I mean, what if you last 30 years you worked in the restaurant industry? You would have seen Taco Bell.
Right.
You would have seen Sbarro's.
Right.
You would have seen Pizza Hut. You would have seen Chili's. You would have seen these companies doing very well. You should have bought those instead of trying to buy biotechnology stocks you know nothing about. I mean, I know nothing about local area networking. A lot of people are buying this Cisco. They're buying the equipment, saying, we're going to route together all these peripherals and put together the servers.
Well, but that's not a bad buy because they own a huge percentage of their market.
But they're saying only a few people had that. I said, my God, if it works for us, other people try it, then colleges will try it, high schools will try it, then they'll go overseas. They knew they were early in the ball game.
Right.
And they should have been buying that company instead of out buying something they don't know anything about, some oil drilling company. I mean, people have this tendency to always buy something they don't. All you need is a few, Charlie, all you need is a few good stocks a
Yeah, but
decade.
this is your song. This has been your song for a long time.
but
Only
here's the
buy
point.
what you know.
No, but people are waking up in the morning and say, there's 5,000 companies out there. Which one should I buy? The average person ought to be able to follow 4 or 5 companies. They ought to be able to lecture on them. They understand the companies. And this forces you. This tool says to you, write down the story.
All right, but you keep saying this. The Stock Shop is what? What is it? This is a CD-ROM that you plug into your CD-ROM and play through your PC, and you come up with what?
Well, also it's a data stream that you can update information on 5,000 or 6,000 companies right like that. You can get 10 years of financial data, 10 years of income statements, 10 years of inventory. So you can get updates on all these companies.
But that's what you get on a Bloomberg terminal.
No, but it's only right now. And it doesn't pick 50 data points. It doesn't go over 5 years. This, on the companies you want to look at, it'll give you all the information.
Out of this?
It costs $6.95 a month in addition, and you get a free trial.
I see.
You get a free trial. We get a cut rate deal, and you can also buy it. You can get it from Fidelity for special programs. But this is something. This will help you update it. So you can say, this is a company I want to look at. I want to see what do the cash looks like. And if you don't understand what cash is, if you don't understand what debt is, I always said, let's say you're looking at companies that are doing poorly, that they're not doing very well. Why don't you buy the one that has $300 million in cash instead of the one that's almost bankrupt? I mean, a lot of companies are selling at $2 or $3 a share. They might be losing $10 million.
That's a no-brainer, isn't it?
But people don't do it. And
Well, they
with
don't do it because they don't know how to do the research.
Well,
and
this
B,
you can look up the balance sheet. Say, listen, they got $300 million in cash. They're losing $10 million a quarter. They'll be okay.
Yeah.
This other company's got no cash, $700 million in debt. They're about to blow taps.
But you're telling every small investor in America anyway they ought to invest in a mutual fund, aren't you?
I'm telling you, you can do both. You could be investing in mutual funds, and occasionally you should be able to find a stock that's going to make a difference in your life.
If it's an industry you know something about.
Industry or a local company. I mean, there's a lot of people that sell the Quinta motor ends in Texas. They said, my God, there are a lot of people have seen local companies. Friendly's. There's been companies come along locally. The people made St. Jude Medical made a lot of money for people.
What was that motel you stayed in, and then you went and bought a bunch of it?
Yeah, La Quinta motor.
Was that La Quinta? That's what it was, right? You stayed overnight there.
And I
said,
also got advice from somebody that was a competitor of this. There's a Holiday Inn guy saying, this guy, boy, they're killing us. They're tough. So that way, you get a lot of information. Don't throw it away.
All right, before you go. So what, you buy this thing, and is it going to charity or not?
Well, all my profits. I mean, Houghton Mifflin is the person marketing this, and they're keeping some profits.
You haven't made them a charitable company
and
yet.
the company the company that's selling it, if you go to Borders or you go to Coffee USA, they're not. Their name. Everything I've done, all my books and on this, my wife and I contribute everything to charity.
Is this because you made a bunch of money, and so therefore, what you do now, you want to be?
That's part of it. But also, even if I hadn't made a bunch of money, I'd like to see people do a better job. These are people. I mean, when you used to retire,
your crusade is to influence the investing habits of America.
To have them do a better job. If they're not ready to do it properly, they shouldn't do it. And it used to be able to retire and you get half of your last year's salary. Yeah. You'd have a pension. You could rely on that. Now you have to do it for yourself. Some people are presented, they're let go or they're early retirement and they're given $500,000 and they say, this is it. This is your retirement, lady. You've got to take care of it now. And some people have lost all that money in options in the last 3 months.
So what you're saying to people today about the future of the market over the near term is what? What's your feeling.
We can take
I got to buy business
We can
about
take a coin out and flip it. I have no idea what the next 1,000 points is going to do. The next 6,000 points is going to be up. The next 14,000 points is going to be up. The next 20,000 points is going to be up.
But you don't know what the next 1,000 is going to be. It
Nobody
could be down,
does.
could be up.
Nobody does. And it's futile to try and guess it. Corporate profits will be a lot higher 10 years from now. They'll be a lot higher 20 years from now. That's what you could rely on. Microsoft didn't exist 20 years ago. Staples didn't exist 20 years ago. Federal Express didn't exist 20 years ago. New companies will come along. That's what makes
Cisco
stocks
didn't
go up.
exist 20 years ago.
That's what makes Amgen has two $1 billion drugs. They didn't exist 20 years ago. New companies have come along. That's what makes this country work. You got to keep your eyes open.
Okay, is the game over in Asia?
No, God, no. You kidding with, some of these countries have a 56% savings rate. They have a high literacy rate. The game's not over. They're gonna have to.
But have they lost something?
Well, they're gonna have to. Some of their lending, they get carried away. They're gonna have to, step back, figure it out, and go ahead. It's certainly not over in Asia. No way.
So emerging markets is still a big deal.
Right, big deal.
What about all the criticism of derivatives and the impact they have had?
That's a little complicated for me. All I know is, I don't know about derivatives.
For you?
It's way over my head. I've never bought an option in my life. I never bought. Time's on your side when you own a stock. I don't know about putting 3% down and buying a future and a strap and a straddle. That's way over my head. Can't deal with that.
Is that right?
Let somebody else deal with it. Yeah.
All right, so you're optimistic about the future of the American economy. Earnings potential for most well-run companies will do all right.
But people have to understand we've had 9 recessions since World War II. We'll have other recessions.
But we're not in one now.
But we may have one in the future, and don't get worried about it. It will have one. Sometime it'll happen, and no one will tell you when it's going to happen. It's just,
but won't the fundamentals tell you?
No, you'll find out after the fact. All of a sudden you'll notice orders slowing, prices get more competitive, then earnings are down. Usually you find out after the fact. No one declares. Everybody's been saying we're going to have a recession for 5 years. It just hasn't happened.
It's great to see you. I hope you'll
Charlie.
come back anytime, Peter.
Excellent.
Thank you
Thanks,
very
Charlie.
much.
To follow his rules.
Hi, my name is Peter Lynch. For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more. I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has. In Stock Shop, I'm here to help you find them and use them. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year. Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000. Go ahead and play with the numbers yourself. If you clicked on the Assumptions button on the previous interactive screens, you noticed that the worksheets do not take taxes into account. When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, KEOs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible. The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you can do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down?
In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Many people ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow.
Your advantage in picking stocks is your direct experience with companies as a consumer, on your job as a professional, or as a neighbor. Use those advantages as a place to start looking for good stocks.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products. You see some services that are terrific. We bought a Volvo. It was better than the American station wagons. It was safer. The price was right. I did a little bit of research. I found that Volvo, the stock, it's a Swedish company, was selling equal to its cash. You're paying almost nothing for the company. They had lots of other divisions that were doing terrific.
Buying that car turned out to be a great way to begin researching the stock.
Sometimes people take things for granted. My field was the mutual fund industry. In the early 1970s, the industry grew slowly, but then it took off in the 80s. Money piled in to money market funds, to equity funds. Like an idiot, I missed stocks like Dreyfus, Pioneer, T. Rowe Price, Strategic Investments, Franklin Resources. There was lots of companies that went up dramatically. These are my own field. All I had to do was buy these things. It was really dumb. Back in the 1950s, a fireman from New England noticed a factory in his town seemed to be hiring and expanding all of the time. This person didn't have a Cray computer, and he wasn't a professional investor. He was just an observant neighbor. He decided to put $2,000 per year into TAM brands, then called TAM packs. By 1972, the fireman was a millionaire, just from using his local edge. Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain. It's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
If you know something that will drive a company's earnings higher, you know something that will drive the company's stock higher, sooner or later. But you can't just guess at it. You have to have some reasons, such as costs are coming down or a new product's going to be a big hit. Research is developing a company story, an idea of why earnings should go up or down. It doesn't mean sitting in the library for hours, reading SEC filings, or fiddling with a calculator.
Research is exciting. It's very little math. When I owned Chrysler, it was the biggest position in my fund. When I was at a movie theater, at a sports event, I'd run into somebody driving a minivan. I'd ask them, what do you think of the minivan? Would you buy another one? What do you like about it? Some would say, well, it's a little underpowered. They only have a 4-cylinder engine. I knew they were already working on a 6-cylinder engine. So this is research.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. It's a lot of fun. It only takes a few hours a month. It's not a full-time job. I owned Dunkin' Donuts for 12 years. I think I might have talked to them once every year. The story didn't change a lot. You don't have to worry about low-cost imports coming from Korea when you own a donut company. You don't have to worry about the economy. You don't have to worry about somebody inventing a new computer chip. The story doesn't change that much. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they had just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu, they kept their costs low, they added breakfast, they went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow. Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market. You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. In 1990, Saddam Hussein went into Kuwait. The banking system was in trouble. We had a recession. You had all this background noise. Lots of good companies had nothing to do with wars, nothing to do with banking. They all went down in 1990. The market fell from 3,000, it fell over 20%. This gave you a great opportunity to buy terrific companies at very good prices. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. This is a company that's had 35 years of double-digit earnings growth every single quarter. We've had changes in the Supreme Court. We've had the stock market go up and down. We've had changes in presidents. We've had recessions. We've had wars. All of those things had no effect on automatic data processing. So every time the market went down, it gave you a chance to buy it. You're saying, I believe strongly this company's going to do well. If you start to see symptoms that's not going to happen, the stock's going to very rapidly respond to that. If the company runs out of steam, the stock's going to run out of steam. Look at Fannie Mae. From July through October 1990, the Standard & Poor's 500 fell 21%. Fannie Mae fell from about $42 a share to about $26, even though earnings were still increasing. This was a terrific time to buy Fannie Mae. The company was doing well, management was still great, the story was solid, and they had a very good business. But you got to buy the stock at a 38% discount. If you start by looking at the entire universe of stocks, more than 3,000 stocks on the New York Stock Exchange alone, and over 13,000 public companies in total, you'll blow a gasket. So I break stocks into categories, partly to make the job of researching more manageable. Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company. You simply can't expect all stocks to behave the same. Basing a strategy on general maxims, like sell when you double your money, or sell when the price falls 10%, is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches, different expectations, and different kinds of stories. Suppose you've made a 50% gain on 2 companies. One is a fast grower with a long way to go. The other is a big, lumbering, slow growth company that has already saturated 95% of its market, and that market itself is growing slowly. The 50% return is fantastic for the slow grower. The chances are it's time to sell it. The same 50% return could be just the tip of the iceberg for the fast grower. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds. At the end of this presentation, you'll have an opportunity to explore each category in more detail. In the meantime, remember, categories are guidelines. They are not hard rules. Some companies may not fit neatly into a category. Others may seem to be in 2 categories at once. Almost all companies change categories at some time throughout their lifetimes. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclicals experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclicals again. Use the categories as guides to help you build your story, but don't let them limit the questions you ask or the research you do. One thing we can say about companies in general: it's easier to go from $100 million in sales to $200 million in sales than it is to go from $10 billion in sales to $20 billion in sales. So smaller companies tend to have more upside potential than larger companies. But don't dismiss all big companies out of hand. Some big companies defy their size and find exciting new ways to grow their earnings. As well, good opportunities exist in companies that are cyclical, regardless of their size. When most people think about investing in the stock market, they dream about investing in a fast grower, a company that is growing at over 25% a year. At 25% a year, a company's profits will double in 3. They quadruple in 6. They go up 8-fold in 9 years. That's how you get a huge stock in a decade. There's not a lot of these, but they're very powerful. And the best part is, you don't have to catch them just as they're taking off. The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money. What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing. One way you can look at growth companies is think of baseball. A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores, and they had lots of malls to go to. Microsoft was a company you could have bought 3 years after it went public and made over 20 times your money. Sales and earnings were growing at several times the rate of the companies in the S&P 500 in an industry that was exploding by leaps and bounds. And it had a lot of potential both overseas and domestically. This was only the beginning of a 15 to 20-year growth cycle. You had plenty of time to get involved. There was this amazing company called Superior Industries. I think the stock went up over 100-fold. They were very good at making aluminum wheels. A lot of car companies went to aluminum wheels. The industry for autos wasn't growing. Aluminum wheels were growing dramatically, and they were the best at it. The fast growers get all the attention in the media. But there's nothing wrong with slow-growing stock, provided you get it at a very decent price. If somebody would say to you, I'm going to sell you a business for $100,000, and they're earning $50,000 a year. You say, what's the bad news? Let's say the bad news is the earnings are never going to grow. They earn $50,000 a year forever. So this is a price earnings multiple of 2. You pay $100,000 for $50,000 of earnings, but they're never going to grow. You say, I don't care. I'm going to get a $50,000 return every year. In 2 years, I get all my money back, and I'm going to make $50,000 a year on my $100,000 investment forever. So sometimes, even if a company has a very low growth rate in earnings, if the stock is selling at the right price, it may still be a very good deal. A slow to moderate grower will have earnings growth of 3 to 15% a year. One company that I was very lucky with was Service Corp International. It's a funeral home company that bought up local family funeral homes, a very steady business. Service Corp could grow earnings at 15% a year when I owned it with very little problems. A slow grower that turns into a no-grower is a very bad news situation. So when you start researching the stock, look for these signs. Steady earnings growth. You can find annual earnings growth rates in the research section, as well as estimates for the coming year. Rising dividends. Companies that raise their dividends each year have to have the earnings to do so. A rising dividend is normally a good sign for a stock. Room to keep growing. You want slow growers to go on forever. That's one reason I like Service Corp International so much. This was a great stock for me in the 1980s. At that point, it had a long way to go. Cyclical companies rise and fall with the economy. Typically, they make expensive big-ticket items that people buy when the economy is good. Things like houses, cars, and furniture. When the economy is bad and people are worried about losing their jobs, they don't buy big-ticket items. They're too broke or too scared that they will go broke. Don't try to time a cyclical stock if you don't have intimate knowledge of the business, if you don't have an investor's edge. Everyone on Wall Street tries to time cyclical stocks too. Because the stock market looks forward, you could be left with a sinking stock even though the company's earnings are terrific. You make your best money in a cyclical when earnings go from rotten to mediocre, or from mediocre to pretty good. The danger point is when earnings go from great to spectacular. Somewhere between these 2 points, Wall Street will figure out there's only one way to go, and that's for profits to go down some point in the future. Just don't buy in the hope. Wait for things to get better, prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big. Let's take a look at Chrysler. In 1990, the company was selling for $10 a share. The economy was lousy. People were talking about Chrysler going out of business. But guess what? The economy came back. Everyone's old car was falling apart. As people made more money, they started buying new cars. And because Chrysler had great products, the minivan, the Jeep, and its first new full-size truck in 20 years, the stock was big. And in addition, very importantly, the balance sheet was decent in 1990. This was not a company about to go bankrupt. If it's a cyclical, you're hoping for a dramatic turnaround in earnings. It's going to happen over 2 or 3 years. Earnings are going to go from a loss to a huge profit. Stock's going to go up and you're going to get out. Make sure you're picking a strong company that can survive when the cycle goes down. That means good cash flow and low debt. If its cash flow is spotty or its debt is high, when the downturn comes, the company faces the danger of going bankrupt. Turnarounds. These are stocks that are battered down, or they're hated companies, or they've been forgotten about. They're depressed in price. But you have determined some one thing or a few things that have the potential for reversing this company's fortunes, independent of the industry getting better or the economy getting better. You always have to do a balance sheet check on any company. This includes turnarounds. Do they have enough cash to make it through the next 12 months, the next 24 months? Do they have a lot of debt that's due right now? These are important questions to answer. Make sure you understand and believe in the plan to restore corporate profits. It's all internal. They're doing something, either new product, new management, cutting costs, getting rid of something inside the company that allows them to improve themselves. Lots of turnarounds never happen, but a few winners can make up for lots of losers. What's important is to wait for the actual evidence of the turnaround occurring, not just the symptoms. The turnaround, you had plenty of time. So just don't buy on the hope. Wait for the reality. Turnarounds are so big, it's worth waiting to get some real evidence. S.S. Kresge was a company going nowhere, in real trouble. They invented the Kmart formula. They rolled it out across the country. The stock went up over 50-fold. Kmart became a massive stock. Sometimes 2 and 2 equals 8. How could this be? Because a company has a hidden asset that isn't reflected in the stock price. When Wall Street wakes up to the hidden assets, the stock could be terrific. Want a great example? Let's look at Disney. Walt Disney is an example of an asset play. After they'd opened up Disney World and after they'd opened up Epcot, the company's growth rate sort of slowed down. They weren't growing very fast. And then they discovered there was a lot of assets inside the company. There was the name Walt Disney. They started the Disney Channel. They started selling things that they sold at Disney World and at Disneyland. They started selling them everywhere. They used their licenses for Mickey Mouse and all their characters. Made a fortune on that. These are on the books for nothing. The company was loaded with assets. In addition, they had all that land inside of Disney World, and everybody had hotels outside of Disney World. They decided to use their land inside to develop more parks, and then even have other companies come in. These companies paid their money to build inside of Epcot or inside of areas of Disney World. So what are hidden assets? Many companies, particularly old line companies, companies have been around
20, 40, 50, 100 years or more have real estate holdings whose true market value is not reflected on the balance sheet in the annual report. In many cases, the hidden asset is the company's name and its reputation. Disney is one example of a company with a great name. So is Coca-Cola. That name can be a huge asset when the company rolls out a new product. This name is carried at little or no value on the balance sheet, whereas it is incredibly valuable. Companies like Intel and AT&T not only make great products, but they have numerous patents for these great products. As long as they have those patents, no one can make the exact same product. That's a tremendous aid in any business. Back in 1987, when the stock market had a major correction, Dreyfus fell to below its price of cash per share. Stock fell from over 50 to under 20. At that point, it was selling for less than its cash. Anytime you buy a stock at less than its cash after subtracting all debt and it has good business, you're getting something for nothing. The price of a stock will follow the direction of earnings. In almost every case, you can generally state that if a company's earnings go up sharply, the stock's going to go up. If earnings go from very poor to mediocre, the stock's probably going to rise. If they go from mediocre to good, it's probably going to have another rise. If it goes from good to excellent, it's probably going to have another rise. Or if a company's earnings grow dramatically over a long period of time, the stock's probably going to go up dramatically. Even if you have a Waterford crystal ball, you probably can't predict a company's earnings. But Wall Street has a whole army of people who make such predictions. By computer, you can get Wall Street earnings estimates in the research section of the stock shop or through many other online services. Or you can go to your local library and find earnings estimates in Value Line or Standard & Poor's. Obviously, you want to invest in companies whose earnings are expected to rise. But again, these are just estimates. If you really understand a company, you should know how it plans to make earnings rise. If you know it has good growth prospects, then you'll be better able to evaluate the company as an investment. You can't predict the future, but you can learn from the past. A company with a long history of earnings increases and dividend increases is obviously a stable performer that has a reasonable chance of continuing to perform well in the industry. Many times that's a good company to investigate further. Johnson & Johnson has raised its earnings something like 19 of the last 20 years. It's raised its dividend over 30 years in a row. But just because a company has had a great record in the past does not mean earnings will grow terrifically well in the future. You have to have reasons for it. Strong growth in research and development, cost-cutting, new products, great brand name, and a terrific balance sheet were the items that made me optimistic about Johnson & Johnson. And what's the outlook? It's going to keep continuing to grow. They run out of steam, stock's going to run out of steam. Price-earnings ratio is something that some people make very complex. It's actually very simple. If a company is selling at $100 a share and they're earning $10, it has a price-earnings multiple of 10. The PE ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant. Why look at PE? It can tell you if you're paying too much for a stock. The higher the PE, the more expensive the stock relative to the company's future earning power. The lower the PE, the cheaper the stock. I use a rule of thumb to level out these differences. A fairly priced stock is a PE that's about equal to the expected annual growth rate over the next 3 to 5 years. If the PE is substantially higher than the growth rate, the stock is normally expensive. If the PE is substantially lower, stock is probably cheap. A stock PE, in part, depends on the industry that it's in. When you look at a growth company, compare the company's growth rate and its own PE to that of the industry. All other things being equal, if you find a company with a much lower PE and a higher growth rate, you're off to a good start. You can also compare a company's PE to its own historical PE. If a company normally sells for 25 times earnings, and now it's selling at 15 or less, you have to ask yourself why. The company could be maturing, competition may be entering the field, and its growth prospects may be uncertain. But maybe it's simply been beaten down by some other factors, and it's possibly a bargain. It's worth researching. Back in the 1970s, Electronic Data Systems, or EDS, had a PE of 500 times earnings. If you had invested in a company with a PE this high when Columbus discovered America, and the company's earnings stayed constant, you'd just be breaking even today. In 1974, EDS performed very well, but its stock fell from 40 to 3, simply because the stock was so grossly overpriced relative to current earnings. Dividends are cash payments that companies make to shareholders, usually every quarter. Nearly half the return in the S&P 500 the past 50 years has come from dividends. Dividends come from profits. If a company earns $5 a share, they have the choice of paying out some of it to the shareholders in the form of a cash dividend. A stock's yield is the annual dividend payout divided by its current price. The yield is the return you get on your investment every year. One drawback: the IRS considers dividends as income, so you have to pay taxes on dividends. Not all companies pay a dividend. Fast growers, for example, almost never pay a dividend. They reinvest all of their earnings back into the company. Slow growers tend to pay out profits in dividends. It's their way of rewarding shareholders. Over time, those dividends can add up. Some people have bought stocks for $5 a share, and 20 years later, they're getting $10 a share of dividends per year. Dividends do make a difference. Dividends are a great way to measure a company's success, particularly a slow-growing company. When a company raises its dividend every year, it raises the bar for its financial performance the years that follow. Few companies want to cut their dividends. Investors clobber the stock, figuring a dividend cut is a sign of worse things to come. So by raising a dividend 12 to 15% this year, the company is saying it expects earnings to be at least as good next year as they are now, and probably rising by at least the 12 to 15%. You can get a list of companies that have raised their dividends many years in a row from Moody's. There are some great names in this list. However, you can find warning signs of dividends as well. A high yield isn't always a good thing. If a stock is 30 and it's paying a $3 dividend, you might say, wow, that's terrific, a 10% yield. But if the earnings are only $3.10 a share, then the company is essentially paying out all of its earnings in dividends. That's only 10 cents to expand or to invest in more efficient equipment. If this continues for a number of quarters or years, the company will have very little room for any errors or setbacks. Eventually, the company will probably cut back or totally suspend its dividend. The stock price is going to tumble with it. Be careful with high-yield stocks, particularly when they're paying out a very high percentage of their earnings. Any company's operations can hit an air pocket from time to time. You've got to make sure your company can survive tough times. The balance sheet tells you about the company's financial structure, how much debt it has, how much cash it has, and how much equity its shareholders have. There's nothing scary about a balance sheet. No story is complete without a check of the balance sheet. The basic concept of a balance sheet is that everything a company owns, its assets, are listed on one side. On the other side, you find everything a company owes, its liabilities. The difference between what it owns and what it owes is its equity, also called its net worth. Go ahead and explore this fictional balance sheet. Click any of the items on this balance sheet for an explanation of it. When you're ready to move on, click either the debt or cash buttons for a discussion of the two most important items on any balance sheet. Does the company have a lot of cash on hand? That's great. A company with a lot of cash can buy more stock, make an acquisition, or pay off all its debt. All moves that shareholders love to see. A company should have at least enough cash to pay off its short-term debt. If it doesn't, it could have to keep borrowing more and more. If you subtract cash from short-term debt and long-term debt, and the total is only 1/4 of net worth, the company has a decent balance sheet. However, if short-term debt and long-term debt combined, minus cash, equals or exceeds net worth, the company has a weak balance sheet. It's simple to recognize a strong balance sheet. No debt and lots of cash. Suppose a company has $20 million in cash after subtracting all debt. If the company has 4 million shares outstanding, it has $5 of cash per share of stock. If you buy the company at $10 a share, you're paying only $5 for the company, and you're getting $5 a share in cash. That's a really amazing price. In effect, that means your real price is $5. If this company has a very solid, predictable business, this extra cash is quite valuable. But if a company has lots of cash and they're losing money, you still have to evaluate how quickly will they run through all that cash. That's all you really have to know. It's not much, but you should know it. You can look it up in the stock shop. If you don't check your company's survivability, you're not only skimping on your research, you're gambling. That's not why you invest in the stock market. Check the debt. Most companies have some debt, but how much is too much? Add up the company's long-term debt and total equity. That's a good approximation of the company's total capitalization, the money the company has available to grow its business in the future. Now compare the long-term debt to total capitalization. If total debt equals half of the company's capitalization or more, beware. That's quite a bit of debt. To service that much debt, everything has to work right. Things don't always work just right.
If debt equals 20% of capitalization or less, that's better. That's fairly low debt.
As usual, there is no rule without some exception. Debt in some industries, like banking, insurance, and financial services, routinely runs much higher than 20 to 50%. Know the industry and what is normal for it when you evaluate a balance sheet. In many industries, such as retailing and restaurants, companies have leases. They have commitments on buildings to rent for a long period of time. Often, this form of debt will only appear in the footnotes. This is a very substantial form of debt. Look into the footnotes. See if you see capitalized lease obligations. Add this back. This is an important exercise.
5 or 10 years ago, investment professionals had a big edge. They got more research and information than small investors, and they got it sooner. But those days are long gone. Basic financial information is readily available from a dozen or more different sources. Investment pros aren't digesting all the good information and throwing just the scraps to the public anymore. Everyone has a seat at the table right now. Here are some places to get started.
If a balance sheet provides a snapshot of a company's financial position, an income statement tells you how the company got there. Income statements tell you how much money the company made or lost from its operations over some period of time. The basic formula is simple. You are asking how things went over the period, usually a quarter or a year. Over that time, you add up all the money the company brought in from selling products or services, then subtract all of the money the company spent to create those products or deliver those services. What is left is the net income. Net income is also referred to as earnings or profits. I hope by now you've been convinced that your story should always include an explanation of how the company plans to improve its earnings or to sustain its growth rate over time. There are only two ways for a company to increase earnings. They can increase sales or reduce costs. Most companies work to do both of these things. The income statement can help you figure out if the company is succeeding. Click any of the items on this income statement for an explanation of it. Once you've explored the income statement, click on Increase Sales or Reduce Costs to explore those topics some more. If earnings equal revenues minus costs, then a valid way to raise earnings is to reduce costs. Reducing costs not only pushes up the earnings number, it makes a company more competitive. If two companies both produce competitive products of similar quality, then the one who can build it more cheaply has the advantage. They can choose to charge less for the product and sell more than their competitor, or can sell it for the same price and make much more money than their competitor. One way to measure cost reduction is to check out the costs listed on the income statement each quarter, but it's difficult to do so because what you really care about is how costs are changing relative to revenues. One way to measure this cost to revenues is the profit margin. This number is not shown on the income statement itself, but is calculated for you in the research section of the stock shop. To calculate the number for yourself, just divide the earnings before taxes by the net revenues. The higher the profit margin, the more money the company makes for each product it sells. Once we have the profit margin as a tool, we can evaluate how successful the company is being in reducing costs. Unless the company has raised prices significantly, if the profit margin goes up, then costs are going down relative to revenues. You can compare the profit margin of the company to the profit margin of a competitor, or to the average profit margin of the industry.
When a company that's highly profitable already must depend on cost cutting to boost its profits even further, you have to be skeptical. If its profit margins are unusually high compared to the rest of the industry, there's a limit to how much additional profit it can squeeze out of the business by economizing. Ask yourself, is there a long road of margin cutting ahead, or are they already extremely efficient? Your goal is to feel as confident as possible with your story. How does the company plan to increase earnings? Sales growth is the single most important factor in growing earnings long term. So you must ask yourself how the company is going to make sales rise. The company can expand its customer base.
Selling its existing products to new customers brings in new revenue. When evaluating this strategy, consider how far the company is from saturating the market for its products. If a company is already selling to 98% of its potential customers, there aren't a lot left to reach. The company can introduce new products into its existing customer base. This is the most difficult, but potentially the most rewarding strategy. If the product catches on, it can breathe new life into the company. Advantages like brand names and a good reputation come in very useful here. A company can also raise prices to increase revenues. That way, even if unit sales stay constant, revenues will still grow. Of course, the danger of raising prices is that the higher prices will drive customers to competitors, or encourage new competitors to enter the market. The details of a company's plan will vary by industry and by individual company. Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully or you'll get burned. Use your story to pick the right time to buy a stock. I promise you that the right time to buy a stock does not occur often. When I'm following a stock, buying opportunities present themselves once or twice a year, if I'm lucky. I look for times when the potential upside is high and the potential downside is reduced. Understanding that balance is a key to successful stock investing. You have to understand, stock picking is a risk-reward trade-off. You have to know how much you're going to lose if you're wrong and how much you're going to make if you're right. The skill is to minimize your risk and maximize your reward. You can be wrong in this business. I've been wrong quite a bit. But you can be wrong and still make money, as long as your good stocks more than offset your mistakes. I figure if I can be right 6 times out of 10, that's a good batting average. When I pick stocks, I think of risk as a measure of my confidence in the story I've built. When I feel that my story is optimistic, solid, and well-researched, then I've got a low-risk investment. If I'm not too sure about how the story will turn out, then the risk is considerably higher. Don't try to categorize risk by other measures, like small companies are riskier than large. In the late 1970s or the early 1980s, Walmart was a lower risk investment than IBM, because the Walmart story was nearly bulletproof. If a startup company sounds exciting, keep an eye on it. Perhaps a year or two later, you will be over the hump, the story will be solid, and there's a good time to consider investing. If you believe strongly in your company's story, then you shouldn't waste your time waiting for the ultimate buying opportunity. Investors who bought McDonald's in the 1970s or Home Depot in the 1980s were happy almost any time they bought the stock. Even with these great companies, during stock market corrections, the stock dipped and the story was solid, but if you held on for a reasonable amount of time, you were a very happy camper. Watch out for ridiculously high prices when a company is selling at several times its growth rate and earnings. Remember, that's what we talked about in the price earnings presentation. But in general, if a story is good, you probably want to own it. Later, if a buying opportunity comes along, the stock falls well below its growth rate, and the story hasn't changed, you can buy even more. Therefore, you can take advantage of market declines. Use the tools I've presented in this consultation to help make a judgment on your stock. If the story is sound, check the price. Use the PE ratio. Most importantly, rely on your edge. First to build your story, then to find the right times to add or reduce your position. Focus on the company. What is it making? Where's its money coming from? What is the competition doing? Ignore all the background noise. Just keep checking that fundamental story. See if it's valid, see if it's getting better, see if it's getting worse. Know what category your stock is in and how those stocks behave. If your stock isn't behaving as you expect, then try and find out why. If the answer changes the story, then think again. Keep your story up to date. Don't check on it 3 times a day, but don't just ignore it either. And checking the price of the stock does not count. It's checking the fundamental story. Don't expect to make a ton of money overnight. The stock market does provide the highest return for long-term investments, but that's not a month or 2 months a year. If you need the money next winter, you don't have the tolerance to keep it tied up for the long term, and stocks may not be for you. Don't forget to use your edge. These are all kinds of things that you know about. because of where you live, what you do. You have lots of edges. Use them. And finally, remember that stock picking isn't gambling, and it isn't for everyone. You have to be prepared to do some work. You have to be prepared for market declines. If you enjoy doing research, if you enjoy learning about companies, and you have the stomach for the ups and downs of the stock market, then investing can be a lot of fun. These principles of investing have worked well for me. I hope they can help you.